time, energy, or matter spent in the hope of future benefits actualized within a specified date or time frame. Investment has different meanings in economics and finance. In economics, investment is the accumulation of newly produced physical entities, such as factories, machinery, houses, and goods inventories. In finance, investment is buying or creating an asset with the expectation of capital appreciation, dividends, profit, interest earnings, rents, or some combination of these returns. This may or may not be backed by research and analysis. Most or all forms of investment involve some form of risk, such as investment in equities, property, and even fixed interest securities, which are subject, among other things, to inflation risk. It is indispensable for project investors to identify and manage the risks related to the investment. Business revolves around the factor of investing, financially, time, in the future, and successful investors will generally focus on certain fundamental metrics for their gains. A value investor is aware that when considering the health of a company, the fundamentals associated with it are a highly influencing factor. They include aspects related to financial and operational data, preferred by some of the most successful investors, for example, Warren Buffett and George Soros. The financial details, such as earnings per share and sales growth, are essential aids for an investor in determining stocks trading below their worth. The price-to-earnings ratio, P/E, or earnings multiple, is a particularly significant and recognized fundamental ratio, with a function of dividing the share price of stock by its earnings per share. This will provide the value representing the sum investors are prepared to expend for each dollar of company earnings. This ratio is an important aspect, due to its capacity as measurement for the comparison of valuations of various companies. A stock with a lower P/E ratio will cost less per share, than one with a higher P/E, taking into account the same level of financial performance. Therefore, it essentially means a low P/E is the preferred option. An instance, in which the price-to-earnings ratio has a lesser significance, is when companies in different industries are compared. An example, although it is reasonable for a telecommunications stock to show a P/E in the low teens, in the case of high-tech stock, a P/E in the 40s range, is not unusual. When making comparisons, the P/E ratio can give you a refined view of a particular stock valuation. For investors paying for each dollar of a company's earnings, the P/E ratio is a significant indicator, but the price-to-book ratio, P/B, is also a reliable indication of how much investors are willing to spend on each dollar of company assets. In the process of the P/B ratio, the share price of a stock is divided by its net assets. Any intangibles, such as goodwill, are not taken into account. It is a crucial factor of the price-to-book ratio, due to it indicating the actual payment for tangible assets and not the more difficult evaluation of intangibles. Accordingly, the P/B could be considered a comparatively conservative measure